So Andrew, as you understand, our organization, the Retirement Education Center, is a full service retirement organization. So we work with a lot of different retirement tools. And one of the biggest retirement tools that we work with are annuities. And one of the biggest advantages to owning an annuity is that it will provide you some tax deferred growth. But annuities do have some unique tax situation on the distribution. They're not all created equal. So we're going to talk about that in today's short educational video. With that being said, I always give this disclosure. I am not a CPA, I am not an enrolled agent, I am not a tax professional. But I do understand some of the minor details of how annuities will be taxed when you start taking distributions from them, depending on what type of annuity you're going to own. So we're going to talk about that in today's short educational video, so go ahead and stay locked in. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And the reason we've created these educational videos is to help to make the difficult and confusing process of retirement simple.
Absolutely, Andrea, and we do this by incorporating a team of strategic partners, ranging from certified financial analysts, certified financial planners, estate attorneys, insurance advisors, and other needed professionals to help us create a roadmap for our clients to let them know when, where, and how they can reach their retirement goals.
For specialized strategies on how to maximize your retirement income, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
So Andrew, the ways that the IRS may tax any type of annuity really solely depends on how you may have purchased that annuity with your funds initially. So if you actually purchase an annuity into a Roth IRA or into a Roth 401k, then when you take money out of that annuity, there will be no federal income taxes that are owed on that particular account. Now, if you have an annuity that was in like a 403B or 457B or even an IRA, then when that money comes out, that money is going to be taxed at your ordinary income tax bracket at the time. Now, there is another type of tax advantage that an annuity may offer when you actually purchase an annuity in a non-qualified account, meaning money that you had sitting in your savings and you decided to just go ahead and buy an annuity with those dollars. And that's going to fall under a really unique tax scenario known as the Annuity Exclusion Ratio. Now, that's probably a really confusing term for many of you out there looking at this video, which is why we try to educate you on these type of things, because you absolutely will be impacted by this Annuity Exclusion Ratio or any type of taxation from an annuity if you actually own one now or may own one in the future. So we're going to dive in a little bit deeper in today's short educational video about how your annuities may be taxed. But before we do that, there are always two rules to retirement income that we want to give you. And Andrew, what are those two rules?
Well, rule number one is to never run out of money. And rule number two is to never forget rule number one.
So let's go ahead and talk about how your annuities may be taxed upon distribution. So today we're going to have a really unique discussion about how annuities are actually taxed. Now, this is going to be a really fun discussion today, because if you own annuities, all of this information is going to be very, very relevant to you. And if you're planning to own an annuity, this is going to be relevant information as well. So for starters, let's talk about the type of annuities that you may own at some point or already currently own. You can have a qualified annuity, you can have a non-qualified annuity, and you can have a Roth annuity as well. Now, if you're not familiar with a qualified or a non-qualified annuity, I highly encourage you to go and take a look at our prior video that we created on qualified versus non-qualified annuities, so you can get a clear understanding of the differences between a qualified and a non-qualified annuity. So as we move on, now we're going to look at how you actually purchase a qualified annuity, a non-qualified annuity, or a Roth annuity. So first of all, you purchase a qualified annuity with pre-tax funds. For example, you have $100,000 in a 401k and you roll that over into an annuity. That money was funded with pre-tax dollars, and then you can just roll that over into an annuity, and at that point you will have a qualified annuity. How do you purchase a non-qualified annuity? You purchase that with after-tax funds. And with a non-qualified annuity, you may have $100,000 sitting in the bank. It's not serving you a good purpose sitting there rotting in the bank. So you want to do something more positive with it, maybe provide income or some other benefits. Well, you can just take that $100,000 and buy an annuity with those after-tax dollars. And when it comes to a Roth, you buy a Roth annuity with after-tax funds as well. So for example, let's say that you had money and you were working and you wanted to fund a Roth IRA. You know there are limitations to a Roth IRA, up to $6,000 if you're under the age of 50, or $7,000 if you're 50 and older. But you can take those after-tax funds as long as you're working, and you can put that $6,000 or so into a Roth annuity, and you can continue funding that annuity with those funds as well, but after-tax dollars, as long as you're still working. That's how you would purchase a Roth annuity. So now let's talk about what happens when those funds out of these types of plans are going to be distributed to you as income. But when it comes to a qualified annuity, all of those dollars are going to come out and be taxed at your ordinary income tax bracket. So for example, you have $100,000 and you took out $10,000 from this qualified annuity, and let's say you're in a 22% tax bracket. That $10,000, $2,200 of it is going to be taxable to you. So $2,200 is going to be taxable on those dollars. When it comes to a non-qualified annuity, that money is partially taxed, and you're going to be under a little-known IRS rule known as the Exclusion Ratio, and so those interest and earnings are going to be partially taxable. Now, we're going to talk more about the Exclusion Ratio in just a moment. So, for example, you have $100,000 that you placed into a non-qualified annuity. It had grown to $120,000. Well, you take that money out, only $20,000 of those dollars are going to be taxable. The $100,000 will not be taxable because you purchased those funds, and those funds have already been taxed at one point of time. So that money will not be taxed again. But the interest that you earned on that annuity will be taxed at your ordinary income tax bracket. When it comes to a Roth IRA, totally different, right? So you have $100,000 that had been placed in a Roth IRA over time. It had grown to $120,000. Well, when you take any income out of it, as long as you're following the 5-year rule, none of those funds are going to be taxable to you. So you can put money in after tax, it grows tax deferred. That money comes out tax free. So let's move on. Let's move our discussion a little bit further along. So we mentioned a non-qualified annuity, and we want to talk about this exclusion ratio because it's really important when we're talking about money coming to you from a non-qualified annuity. So let's take a look at this example and how the IRS will actually tax your funds from a non-qualified annuity when it's based on the exclusion ratio. So let's say you're age 66. You purchase an annuity for $100,000 and you request them to pay you monthly. Typically, this is when the exclusion ratio is going to come into play. So you're going to receive some type of income from an annuity. Let's say they have agreed, based off of your age and the annuity company that you're with, that you're going to get paid 6% on that $100,000. And so you're going to receive a monthly income of $600 per month. And what they're going to look at is what they think your life expectancy is going to be. So let's say your life expectancy, according to this insurance company, they had is at age 85. So that's going to be 19 years that this company is going to pay you under the exclusion ratio, where you're going to have this really unique tax rate. So they're going to pay you for 19 years, $600 a month under this the annuity exclusion ratio. With that being said, $600 at 19 years is going to equate to $136,000 that you would have received from that insurance company over that period of time. So here's how they look at how much of that money is going to be taxable to you. They take that $100,000 that you initially started with, and they divide it by the amount of dollars projected to that you're going to receive over that period of time. And that's going to give you the percentage of how much of those dollars are going to be tax-free. So in this example, 73.5% of those funds would be tax-free. So basically, when you're looking at the amount of dollars you're receiving monthly of that $600, 411 of it is going to be completely tax-free to you, and $159 is going to be taxed at your ordinary income due to the exclusion ratio of only having 73.5% of that $600 be taxable. But here's what happens. After 19 years, if you outlive those 19 years, that can happen, right? There are plenty of people who live past age 85. Doesn't mean your payments are going to stop. But what will happen is that you're going to lose that annuity exclusion ratio at that time. And therefore, all payments that come to you are then going to be completely taxable. So, as we say in all these videos, no matter what your situation may be, just understand that you want to consult with a competent financial advisor or a tax advisor to make sure that they go over all the rules and regulations regarding your personal situation. So I really hope that this video really gave you some insight into how your annuities may be taxed upon distribution. Please remember that these videos are created for educational purposes only, and always consult with your own personal financial advisor or tax advisor concerning your personal situation. For more information on this topic or any other topics that we've covered in our other videos, please feel free to leave any questions or comments in the section below.
To learn more about our services and how we can help you to increase your chances of not outliving your retirement income, make sure to click on the link in the description below and sign up for our free Maximizing Your Retirement Income Masterclass. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. Also, if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.